Hi, this is Bruce with Clayton-Biltmore Financial. Is your portfolio insured? Bet you haven't heard of that before. Well, let me explain. Are you investing in a retirement portfolio that's mainly in the stock market without any protection from downside loss? Okay, why would you be doing this? What happens if all of a sudden your portfolio evaporates by 30% overnight? That can happen. It's done in the past. It could do it again. The world is so interconnected. Something that happens on the other side of the globe can affect our stock market. So why do you want to deal with that kind of stress? Okay. Why? Because you're probably following the stock bond portfolio mix based on your age. It's what stockbrokers recommend, and they've been recommending that for years. But we're going to talk about two ways to protect yourself and replace the stock bond portfolio so you don't have to worry about risk. Okay. First, let's talk about the stock side of it. Okay. Because you're going to have a portfolio made of stocks and bonds. Most of you have been through the 2008 downturn. When was the last time your financial advisor got to you ahead of time and said, sell, you're going to have a big downturn, jump out? They don't. Anyone had that? If you do, you got a great financial advisor. But what do? After the fact, they tell you, hey, don't worry about it. Just stay with the market, be patient, and you're going to rebuild everything. But of course, that takes years, okay? We can show you how not to lose money in the first place, okay? So we'll tell you how to structure that. Secondly, let's talk about bonds. Why do you have bonds in your portfolio? Because you're looking to offset the volatility of stocks and get a steady stream of income. But why do you want to invest in someone else's debt? The world has $300 trillion worth of debt. So why do you want to bank on someone else paying you back what they've borrowed? The only bond that can't go bankrupt is the Treasury bill, and that's because the federal government can print dollars. So let's protect yourself from risk in both those aspects, okay? What's a solution? It's annuities. You may have heard of them before, but let me talk about them specifically as they relate to each side of this. First of all, on the stock side, we have what are called fixed indexed annuities. But let's go back and take a step back. What are annuities in the first place? They're investments with insurance companies, okay? Insurance companies are some of the most financially stable entities out there. Okay, they know how to invest money. They've been doing it for hundreds of years, and they're very good at it. What crises are you hearing about now? Are you hearing about the insurance crisis? No, you're hearing about the banking crisis, right? One of the reasons insurance companies don't get in those kind of problems is they don't practice fractional reserve lending. That's what banks do, and that's how the credit's created. Okay, so a bank only keeps a minimal amount in the bank to cover deposits, et cetera. So that's why they can't stand runs on the bank, because they don't have the money there. Insurance companies are way more capitalized. Plus, they've got a steady stream of income. Okay, they're very strategic. They take long-term plans, and they have a lot of cash to use. Why does Warren Buffett love insurance companies? Because they get a lot of cash to invest. So why not ride the wave with them? So let's talk stocks. You can replace your variable stock portfolio with a fixed index annuities. Okay, when the market goes up, you participate. If the market declines, you don't lose your principal. So let's say you put 100,000 in, and the market goes up 10%. Okay, so the next year you're starting out at 110,000. The market goes down 50%. Well, you still got your 110 that you're starting with. Okay, see the benefit of not having to make up all that extra ground that you lost? You also have professionals manage your money. Like I said, the insurance companies are experts. And here's the other thing. Even though it's protected, you can get an access to a portion of your portfolio yearly. Okay, so as it increases, you can always take profits off the top. Now, what are the downsides? Well, first of all, you're investing your money for the longer term. This is not something for somebody who wants to jump in and out or chase the latest thing. If that's what you want to do, this isn't for you. Secondly, you don't get all the returns. In exchange for protecting you from the downside losses during the bad time, the insurance company takes percentages off the top. Okay, seems fair to me, right? You're protected, and they get to profit from their capabilities and performance. Okay. So your life is protected, your house is protected. Why not protect your portfolio? Why stress yourself out? Now, that's stocks. Let's talk about bonds. Okay, the reason you have bonds in your portfolio is to offset the volatility of the stock market. But what's protecting the bond volatility? Nothing. Okay. So why do you want to bank on someone else paying you back so that you can use that money to live? Why not go ahead and solve this with a multi-year guaranteed annuity? What is that? It's like a CD on steroids. Usually they pay probably 1% higher than a CD. You have access to a portion of your money that CDs don't have, and you'll get consistent income over a 3, 5, or 7 year period, whichever you choose. So you have the performance side with the fixed index annuity, and you have the consistency side with the multi-year guarantee annuity. Okay. So this solves all your problems. You get upside potential, consistency, and no risk. Okay. So the question is, why haven't I heard about this from my broker? Well, one, it's not their model. They make money charging management fees. And many of the companies, the larger companies, do bond placements and things like that. So they need a market to buy them. That's you. So protect yourself. I mean, stay tangentially associated with the stock market, but you get all the benefits without the downside risk. So the next step is talk to one of our retirement planners at Clayton-Biltmore Financial. We'll show you how to get a stress-free financial retirement. Manage the process instead of the process managing you. So we know the goal is to have a stress-free financial retirement, but what are the first steps? Well, the first step is you got to get your financial house in order. One of the tools we use is Asset Map. You'll see on the screen what an asset map looks like. Basically, what it is a one-pager that lists out all your financial resources. So it tells you where you stand at any one particular point of time so you can address things that need attention. For example, do you have a 401k you haven't looked at in years? Do you have a lot of cash sitting around that you want to put to work? Are you diversified so not all your eggs are all in one basket? So you want to manage the process, and this is the first step. The good thing about filling out Asset Map is it's not invasive with asking you for account numbers or anything like that, and it's not time consuming. Like I said, it gives you a snapshot of where you are in regards to retirement planning, and then one of the retirement specialists at Clayton-Biltmore can provide recommendations on the steps you need to take to achieve a stress-free financial retirement. And it's all done in an easy to understand format. The process isn't complicated, it's just very thorough. Let me just say this. If anyone's trying to overwhelm you with complex multiple page reports you don't understand, then you're in the wrong place. You should have an easy to understand retirement plan, knowing where your money is, where it's invested, and what you're trying to achieve. So talk to one of the retirement specialists at Clayton-Biltmore to see how you can achieve a stress-free financial retirement. To paraphrase the Geico commercial, 15 minutes can give you a stress-free financial retirement. So please reach out to us if we can help. Thanks so much.